First, I'm going to explain about ethical problem. First, staff purchases process outside the accounting system. When staff make purchases and record them outside the official accounting system, the losses control and oversight of this transaction. This bypasses standard financial control and increases the risk of errors or international misuse. Second one is misappropriation of company asset. Processing transaction outside the system can lead to employee using company resources for personal benefit or unauthorized purposes. This constitutes misappropriation as company assets are being used without proper authorization or record. Third one is inaccurate or false financial statement. Unrecorded and improperly recorded transactions distort the company financial reporting. This can mislead management, investor, and other stakeholders, undermining the reliability of financial statement. Fourth one is potential tax irregularities. If income or transactions are not properly recorded, the company may underreport revenue or expenses, leading to tax non-compliance. This could result in penalties or legal consequences. Next is identify affected parties. First, the accounting firm. Ignoring or concealing irregularities in client accounting exposes the firm to serious professional and ethical risk. The firm's reputation depends on maintaining integrity and to accounting standards. Failure to report such issues can lead to loss of credibility, legal consequences, and potential action from regulatory bodies. Second one, the client company. The company itself is directly impacted because processing transaction outside the accounting system can make its financial statement inaccurate. Inaccurate reporting may lead to non-compliance with accounting standard and legal regulation, potentially resulting in fines, audits, or other legal penalties. Third one is the company director and employees. Individuals involved in unauthorized sales or misuse of company funds may face internal disciplinary measure or even legal action. This affects not only their personal careers but also the overall trust and morale within the organization. Directors have a particular responsibility to ensure proper financial control are followed. Fourth one is tax authorities. Unrecorded sales distort the company tax filing, meaning tax may be underpaid or misreported. This affected the authorities' ability to collect revenue accurately and may trigger audit penalties or legal investigation for the company. Next is explore optional solution. Option 1, ignore the issue, maintain the relationship with the client. Choosing to ignore the irregularity may seem easier in short term as it avoids conflict and preserve the client relationship. However, this approach is unethical and risky. It compromises professional integrity, exposes the accounting firm to legal liability, and could damage its reputation if irregularity is later discovered. Option 2, privately discuss the issue with the directors. Addressing the matter directly with the company director allows for a constructive resolution. It gives the director a chance to correct the irregularities and implement proper controls. This approach balances ethical responsibility with professionalism, but it relies on the director willingness to take corrective action. Option 3, report the irregularity formally within the firm and consider withdrawing from the engagement. The issue internally ensure that the firm addresses the problem according to its policies and professional standard. If the client refuses to correct the misconduct withdrawing from the engagement protects the firm integrity and limits exposure to legal or ethical violation. Option 4, report the matter to appropriate authorities if the misconduct continues. If measures fail and the irregularities persist, reporting to regulatory or legal authority is necessary. This ensures compliance with and professional regulation, protects stakeholders and demonstrates the firm commitment to ethical standards. While this step may have serious consequences for the client, it upholds accountability and the public interest. Next is evaluate the each solution. Option 1, ignore the issue. Ignoring the irregularity may seem convenient because it temporarily preserves the relationship with the client. However, this approach violates core ethical principles such as integrity, objectivity, and professional behavior. It also exposes the firm to legal risk and potential reputation damage if the issue is later discovered, making it short-term solution with the long-term consequences. Option 2, discuss with director. Privately discussing the issue with the company director encourage them to correct the irregularity internally. This approach allows for ethical resolution while maintaining a professional relationship with the client. The risk is the director may refuse to act either because they underestimated the problem or do not immediate harm, which would leave the ethical issue unresolved. Option 3, formal reporting or withdrawal. The matter formally with the firm or withdrawing from the engagement demonstrates strong professional integrity and to ethical standard. This protects the accounting firm independence and ensuring compliance with regulation. This downside is that the firm may lose the client and associate revenue, which can having implication, but it prioritizes long-term professional reputation over short-term gain. Next, select and justify the best solution. Okay, the best solution is option 3. Option 3 is considered the best solution is it fully aligns with core ethical principle of the accounting professional, including integrity, objectivity, and professional behavior. The first step is communicate the issue the company director, giving them the opportunity to correct the irregularity by ensuring all staff, sales, and are properly recorded in accounting system. This approach encourages internal resolution while maintaining professional relationship. If the director refuse to take corrective action, the accountant must document the issue carefully and consider terminating the engagement. Withdrawing protect the accountant independence and professional integrity, preventing involvement in unethical or illegal practices. The matter external authorities is only necessary if required by law, ensuring compliance while minimizing unnecessary conflict. Overall, this solution balances ethical responsibility, professional standard, and legal compliance, safeguarding both accountant and the firm in the long term. Next, I'm going to explain about fundamental principles that feature more prominently for safeguarding. The principle is integrity is central to safeguarding ethical standard in accounting. It requires that accountant must be associated with any information that is false or misleading, whether intentionally or unintentionally. In the other context of the company where sales are being processed outside the accounting system, integrity ensures that the accountant takes responsibility to maintain honesty in reporting, preventing financial statement from being misstated and protecting the trust of stakeholders. This principle helps uphold transparency and credibility, which are essential for the reliability of financial information. Objectivity and professional behavior are equally critical in maintaining ethical safeguard. Objectivity ensures that the personal relationships, such as a close connection with the director, do not influence professional judgment. An accountant must make decision and avoid conflict of interest. Professional behavior complements this by that one avoid any that discredit the profession. Engaging or ignoring unethical practices, even under pressure from management, could damage both the reputation and that of the accounting profession as a whole. Finally, professional competence and due care along with confidentially reinforce responsible and careful practice. Professional competence and due care require accountants to ensure that financial information is accurately recorded and reported, applying technical knowledge correctly and to prevent misstatement or omission. Confidentiality, meanwhile, that any sensitive information obtained through personal or professional relationship is handled responsibly. In case of breaches, accountants should use this information appropriately to address the issue without causing unnecessary harm, balancing transparency with discretion to protect all parties involved. Next is key consideration in resolving the dilemma. The first step is resolving any ethical dilemma is to identify the ethical tree. This involves recognizing the specific situation or behavior that could compromise ethical principle. For example, if sales are being recorded outside the official accounting system, this constitutes a risk of misappropriation of assets and false financial reporting. Identify the threat clearly, help the accountant understand which fundamental principles such as integrity, objectivity, and professional competence are risk of being violated. Without proper identification, it is impossible to address the issue effectively. Once the threat is identified, it is crucial to exercise professional responsibility. This means understanding the obligation of the accountant under professional and legal standard. The accountant must consider their duty to the organization, stakeholder, and professional itself, balancing loyalty to the client with the needed ethically. After assessing responsibility, accountants should evaluate possible action and consequences. This includes consider all options such as reporting the issue to management, suggesting corrective action, or interim cases withdrawing from the engagement. Each action should be analyzed for the potential impact on the company's stakeholder and accountant professional reputation. Finally, safeguard to apply are measures that reduce and eliminate threat. Safeguard might include implementing stronger internal control, consulting an ethics or compliance committee, or documenting all steps to ensure transparency. Applying ensure that the accountant addresses the ethical dilemma responsibly while protecting both the organization themselves from the potential ethical violation. Finally, cause of the action. To resolve the dilemma to maintain a consistent professional stance, the accountant must first clearly communicate their concern about the issue. In this case, the issue is certain staff sales are not being recorded within the company accounting system. Highlighting the concern ensure the directing understand the potential consequences such as inaccurate financial misappropriation of asset and potential legal or regulatory breaches. By addressing the matter directly and professionally, the accountant demonstrates integrity and uphold the of profession. The accountant should then advise the director on corrective action. This includes ensures that all transactions are properly recorded in the accounting system so that the company financial statement accurately reflect all proceeds. It also involves establishing internal control procedures to monitor future transactions and prevent similar ethical breaches from occurring. By taking this approach, the accountant not only safeguard the company financial integrity but also help the directors comply with legal and professional requirements. If the director refuses to take corrective action, the accountant must take steps to protect themselves and profession. This includes a wide association with unethical practices which could compromise objectivity and professional integrity. At the same time, the accountant should maintain confidentiality while ensuring that they comply with professional standard and legal obligation. This may involve formally documenting the issue and, if necessary, withdrawing from the engagement to prevent complicity in unethical behavior. This course of action balances ethical responsibility with professional prudence. That's all from me. Thank you.